Well, very good morning, everybody. Welcome to the London Business School. Those who are here as visitors, welcome back, alumni. Very pleased to see so many people here. I'm not surprised, bearing in mind the fame of our speaker. As you will, many of you will know, this is the 50th anniversary of the London Business School, and it's customary at birthdays to look back a little. Normally, we're too busy looking forward to look back. But one of the things that we have found in looking back at the London Business School's history is the very important role that economics has played over its entire period. From the very beginning, we had an economic forecasting unit that gave the school a great deal of publicity, because at the time that was the sort of leading British macro forecast, and that very much catapulted the school to prominence in the wider community. But over the years, what's happened is that the role of economics has changed and developed. And indeed, we have here Matthew Bishop. Matthew was here in the midst of the 50-year period as part of the Centre for Business Strategy. Because at that time, then a group of economists led by John Kay, which included Matthew and also included Stephanie Flanders, Gavin Davies, a number of people who have gone on to do things in other areas, were here just as active in the economic field. But today we're very proud of the fact that economics also plays an important part in the life of the school. And indeed, Hélène Ray, who you'll hear in a moment, was named in September as one of the 25 most influential economists under 45 by the International Monetary Fund. I should say, by the way, that of the 25, 23 were in the United States. Hélène was number 24, and our speaker today was number 25. So you are in the... Sorry, they were not ranked in that order. I just want to make clear. Okay, very, very clear. Okay. They were all ranked completely equally, as befits the International Monetary Fund. And so you can say that we are in the presence of the most influential economists under 45 outside the United States today, which is great, as it should be. What has changed, of course, since the London Business School was founded is the fact that we've gone from a largely British school to being a very, very international, global school. We have students from many countries, 106 countries, faculty from 31, staff from 60. And this is very much, therefore, a global school in contrast to the rather British school, which started off in the 1960s. But what hasn't changed is our great interest in the link between cutting-edge theory and practice. And today's speaker exemplifies, I think, very much the kind of challenges which somebody brings to the policy world in looking at the aspects for society of income inequality. And Thomas, we're very, very pleased to see you here today. Thank you very much.
Good morning. So as academics, we have followed Thomas Piketty's work for quite a while on inequality, wealth inequality, income inequality, optimal taxation. It is absolutely path-breaking work. It is extraordinarily careful work, data work. And in his last book, Capitalism in the 21st Century, Thomas has literally taken the world by storm. So today we are extremely happy to have Thomas with us to discuss these very important issues for society, for business. And we know that he has had an extremely busy schedule, so we are very, very grateful to him for being here with us today. We are also very fortunate to have two very distinguished discussants. Gavin Davies, who is chairman of Fulcrum Asset Management and an FT blogger, and Matthew Bishop, who is the global economics editor at The Economist, and who has also written on Philanthropy. So Matthew will actually chair the talks and also the Q&A. Matthew, the floor is yours.
Very well, good morning, everyone. It's great to be back at London Business School. It's quite chastening to realise it's almost 25 years since I left and went off to The Economist. We've really celebrated Thomas's arrival on the scene. I mean, at one point, we described him as bigger than Marx, which I guess is a classic economist way of both praising and damning in the same very brief subhead, brief title. And you know, it's really a great honour to be on this platform today. And I think you raised, I mean, I know that we were writing about inequality a lot, and I found it very hard to get mainstream economists to take seriously the rise in inequality, because they were ignoring both ends of the distribution and focusing on the 90%, where the story seemed to be reducing inequality. And so it's been great to see, I think, the debate around inequality move to, I think, what is a better description of the real world. But you've made a number of very controversial forecasts, and Gavin's going to come on and talk about some of the implications of what happens if you're right. But why don't we just start by asking you to sort of outline what you're thinking about at this moment in terms of how this narrative goes forward.
Okay, thank you. So maybe let me step there. So, you know, first of all, you know, I should apologize that my English sounds a lot like French, and, you know, I hope it will be okay. So, you know, I'm going to present a number of results from my from this book. So let me first say, you know, I'm not sure this is you know, I'm going to present only a selected number of results, but let me first say that, you know, this book could not have existed without a very collective data collection research program. So, and in particular, Tony Atkinson, you know, with you know, a very well-known British economist, and in a way is the godfather of all historical studies on inequality, together with Simon Kuznets in the 1950s, and Tony Atkinson played a very big role in this data collection process, and more generally, you know, I was very fortunate to find many co-authors. Emmanuel Saez in the United States, with Facundo Alvaredo, we worked on Argentina, with Abhijit Banerjee on India, and we have tried in this work to extend very much the approach of Kuznets to many more countries, many more years. And, you know, this was not done before, I think partly because, you know, it was more difficult to do it without the modern information technology to collect so much data. Also, maybe because the boundaries between academic disciplines sometimes are a bit too sharp, so maybe this data collection work was viewed as too historical for economists and too economic for historians, so nobody was really collecting this historical fiscal data. So there are really two parts in the data we've been collecting. One is on income, the other is on wealth, and to a large extent, what I'm trying to do in this book is to shift the attention from rising income inequality to rising wealth inequality, but of course both are important and both are related. So first, what we do is really to extend Kuznets' work to many more countries. So, you know, this is a map of the world where all the countries in red are already included in the World Top Income Database. Countries in blue are about to be included. In fact, one good thing with the publication of the book is that it induced a number of countries to open fiscal data which they didn't used to open before. So in Brazil, in Mexico, in Korea, in Taiwan, we now have online series and top income shares which were not available at the time of the book, but which are now available on this website. And in many of these countries, you know, I think the book contributed to put pressure on governments so that they would open their fiscal data, which in many cases, like in Brazil, for instance, it's changing quite substantially both the level and the evolution of inequality, and generally not necessarily in the good direction. So let me show you one example of what we get with this data. So this is for the United States. So you know, this is the share of total income going to the top 10%. This is the share of total primary labor and capital income going to the top 10%, including or excluding capital gains. But you can see that the long-run evolution are the same with and without capital gains. Of course, the capital gains induce a lot of volatility. You can see at the end of the period, you know, when you have a stock market crash in 2001 or 2 or 2008 or 9, of course, it's not a good time to have big capital gains. But after the crash, you know, the trend seems to be continuing as much as before. So this is the share of total income going to the top 10%. You can see it varies between roughly 1/3 and 1/2 of total income for the top 10%. These are typically the orders of magnitude you have for income inequality around the world. Latin America would be closer to 1/2. Scandinavia will be less than 1/3, maybe 30 to sometimes 25%. For the concentration of wealth, this is always a lot more than that. For the concentration of wealth, the share belonging to the top 10 will vary between 50, 60%, say in Scandinavia, to 70% in the US, or 90% in Britain or France a century ago. So the concentration of wealth, just to get the orders of magnitude, is always a lot higher than the concentration of income. Anyway, you can see you have a lot of variation in concentration of income over time. So the big decline in inequality during the Great Depression and during World War II is exactly what Kuznets found. And so Kuznets was really the first economist, as you know, to compute national accounts for the US. He was the first one to compute GDP series for the interwar period. And he was also the first one to use income tax data for the US in order to compute the share of national income going to the top 10%. And in the 1950s, he published his discovery with the good news, which was a decline in inequality. And this gave rise to this very optimistic view of the Kuznets curve in the 50s, 60s, according to which you have a decline in inequality in advanced stages of development and then a stabilization. So you can see the stabilization in the 50s, 60s, 70s, where you have a stable share around 1/3 of national income going to the top 10%, which means that you have a balanced growth path. It means that when you have GDP growth of 2 or 3% per year in 1960 or 1970, everybody grows at 2 or 3%. The average income of the top 10 grows at 3, the average income of the bottom 90 grows at 3, so all you care about is to have more growth in a way. The entire distribution is being lifted upward in the same proportion. Now, in the 30 years between 1980 and 2010, it's quite a different story, because when you go from 1/3 to 1/2 of total income to the top 10, it's not just, this is of macroeconomic significance. This is not just a few people who get richer than average, which, after all, nobody cares about. It becomes, these are big numbers. Okay? So this corresponds to the fact that over this period, between 2/3 and 70% of total aggregate growth was in effect absorbed by the top 10%. So, if the growth performance had been extremely good, if it had been like, China 10% per year, maybe you don't care that 2/3 is going to the top 10, but although 2/3 is still a lot, but with very fast growth, maybe it would not be too important. But given that the growth performance of the US economy over this period was not particularly good by historical standards, if you have a per capita GDP growth of 1.5, 1.6%, and you get 2/3 to the top, it's not clear this is a good deal for the rest of the population. So many people, I think, now believe in the US that this has contributed not only to the stagnation of median incomes, but also to the rise of household debt over this period, and probably this has contributed to fragilize the financial system. So you see the highest point on the curve until today was 2007, and the previous highest point was 1928. And so now I have put 2012 on the graph. You can see that 2012 is already above 2007, and we will put online 2013 soon with Emmanuel Saez, and it seems to be even a bit higher. So the trend seems to be continuing. What are the explanations for this? So I try in the book to see the different explanations. There are different mechanisms that are playing a very important role here. I think inequality in access to education, access to skills is probably the most important part. Globalization is not enough as an explanation, because you also have globalization in Sweden, in Germany, in Japan. It's not only in the US, and you don't have the same rise in inequality. So you need explanatory factors that are more specific to the US, and specific institution and policy must also play a role. Probably, this must be put in line with the very high inequality in access to high-quality education in the US. So, I show in the book at some point the average income of the parents of Harvard University students right now corresponds to the average income of the top 2% of the US distribution of income. So, of course, you have some students who come from below the top 2, but they are sufficiently few, and the students that come from the top 2 are sufficiently high in the top 2 that the overall average is as if they had been picked at random in the top 2, which, so, it's very good for them, but it means, the bottom 50% of the US population, not only they don't go to Harvard, but the quality of the high school and community college they go to is not sometimes so good. And I think the inequality in educational investment is a big part of, of the forces that can lead to high and rising inequality. There are other issues as well, like top managerial compensation. I think has gone too far in some cases. When you pay top managers $10 million rather than $1 million per year, do you get the extra performance that you would expect to get? We couldn't find it in the data, at least. So maybe, maybe it's there, but it's well hidden. And, I think the large decline in top income tax progressivity probably contributed to rising incentives for top managers in the US to sometimes vote for themselves, pay compensation package that are well above what you can justify on the basis of performance. So now in the book, I'm now going to show you another evolution about wealth accumulation, which, in the book, as I said, I try to shift attention from rising top income shares to the long-run dynamics of wealth accumulation and wealth distribution. This is very important, but this is particularly strong in the US. In Europe and Japan, it is much less strong. Britain is sort of intermediate between continental Europe and Japan, but still it is much less strong than in the US. So let me show you another evolution which is more important for Europe and for Japan. Which is so this is the ratio, so this is what I call the capital income ratio in the book. So more precisely, this is the ratio between net private wealth and national income. Okay? So in the book, I use capital and wealth as synonymous, and I include in capital or wealth all the assets that can be owned by private individuals or sometimes by the government. And so this includes real estate assets, business assets, financial assets, minus financial liabilities. So this is always a net wealth concept. Now, of course, all these different assets have different economic role, involve different economic mechanism, and one of the main reasons why the book is so long is because I try to describe the different history of these different assets. But sometimes it's useful to make the big addition. It's a bit abstract, but I think it's useful for some purposes to see what's the total aggregate value of net private wealth. So according to some economic textbook, this is supposed to be a constant. Well, as you can see, this doesn't look too much like a constant. So, we should be careful with economic textbook. Sometimes in economics, when we don't know much about something, we just assume it's a constant, which, if you have only one data point, of course, everything is a constant. But in fact, there's no reason why it should be a constant. If you take our more standard model of economic growth, where you have capital, labor, substitution, any ratio of capital to output could be a constant. There's really no reason. There's no magic number, 3 or 4 or 5 years. It could be anything. So what you can see is that in European countries up to World War I, you have very high ratio of private wealth to national income. Then you have huge decline during World War I, the Great Depression, World War II, which reflect not only capital destruction, but mostly the fact that there was very little private investment during this period. So a big part of the private saving was used to pay for the war, which was itself used to destroy the other part of the capital stock. So, this is a very stupid process in many ways, but this is the history of Europe, and this is why you have such a low ratio of private wealth to income in 1950. Also, this reflects some policies which reduce the private market value of wealth and do not necessarily reduce the volume of wealth. So, if you have rent control, if you have nationalization, this is going to reduce the private value of wealth. That doesn't mean that the capital is not there. It's just that its private value is lower for their owners. And then you have a long process of recovery, which is certainly not bad in itself. Having higher capital to income ratio is certainly not bad. It's good to have capital, and I'm certainly not nostalgic about 1950 or 1960 where everything had been destroyed. It's just that it's important to realize that we have this long process of rise in capital income ratio. One simple lesson from this graph is capital accumulation takes time. If you save and invest 10% of your national income each year, it takes 50 years to accumulate 5 years of national income in wealth, okay? Because 50 times 10% equals 500%. So, so simple, complicated mathematics, I think, are not so useful in economics, but simple mathematics can be useful, and capital accumulation takes time. This is why it's important to take an historical perspective on this issue. If we now zoom on the recent period, so now I'm going to zoom on the 1970-2010 period, and I'm going to show you more countries. And instead of showing you decennial averages, so these are decennial averages, so everything looks very smooth. When you look at annual series for private wealth to income ratio, everything is much more chaotic because the history of capital is always chaotic. You know, putting a price on assets is a complicated business, as you all know, and it's complicated to put a price on real estate, on the stock market. So when you look at annual variations, it's much more chaotic, but it's important to have in time also the long-run picture within which this short-run variation take place. So let me show you the annual picture. So this is the same private capital to national income ratio in the top 8 developed economies in the world: US, Japan, Germany, France, UK, Italy, Canada, Australia. So probably you cannot see very well all the different countries, but what you can see is that you have all sorts of short-run variations. You have also a long-run evolution. So, you know, every country was between 2 and 3 years of national income in private wealth in 1970, and now every country is between 4 and 7 years. So you have a general increase in private wealth to national income ratio. So again, this is certainly not bad in itself. You know, this reflects a number of issues, you know, including aging, including the lowering of population growth. You know, when you have lower population growth, you tend to accumulate more wealth relative to income. This is not bad in itself, but this raises new challenges about the fiscal system, about the regulatory system, because, you know, when you have 7 years of national income in wealth, if you make a mistake in your price of real estate or price of the stock market, it makes a bigger difference than when you have only 2 years. And, you know, if I were to show you Spain on this graph, you will see that Spain in 2007 had, you know, 8 years of national income in private wealth, even more than Japan in 1990. And, you know, I think had this data been available, you know, maybe it would have been useful for the European Central Bank to try to calm down the process. So these national balance sheets that I am using here are now available in the national accounts of most countries, but they were not available just 5 years ago. You know, in Germany, Destatis, the official statistical institute, published the first consistent national balance sheet for Germany just in 2010. Okay, so this is quite recent that we can study not only the flow of national income, output, consumption, saving, but also the stock of assets and liabilities at their market value. And I think this is important not only for fiscal policy, but for regulatory policy. So what are the explanations behind this rising wealth-to-income ratio? You know, I mentioned the slowdown of population growth, the aging process, that's part of it. The rise of real estate price is clearly part of it. So you can see it in Japan, you know, before 1990. But generally speaking, over the long run, you have an increase in real estate price, and this is something that we know very well, of course, in Paris and London. Now, this, I think, is complementary to the real explanation based on the slowdown of economic growth, which is that, you know, if you have a relatively slow growth and you keep saving and investing, you have to put your money somewhere. And so, of course, you could put it, all of it in China, but, you know, maybe you prefer sometimes to buy real estate in London or Paris and Rome. And so this contributes to feed the real estate bubble. So I think the real explanation and the price explanation, you know, are very much related. Another part of behind this evolution of private wealth is a gradual transfer from public to private wealth. So let me show you on this graph, so that's even smaller, you cannot see it, but what you can see, you know, at the bottom is, so this is public capital versus private capital. So what is public capital? That's also what you can compute now with national balance sheet. This is the difference between public assets, public buildings, public financial assets, you know, if you have a sovereign fund, minus debt. Okay? And you can see, well, first you can see that public capital is always less than private capital. You know, this just means that we don't live in communist countries, but, you know, that's always useful to check that we, you know, we didn't make a mistake. So, you know, public capital has always been much smaller than private capital in this set of countries at least. Now, in 1970, although it was smaller, it was not completely ridiculous, you know, because there was limited public debt and a big public sector. Net public capital in Britain or France, you know, was maybe 1 year of national income. Because private wealth was only 2 or 3 years of national income, it means that in effect the government owned about 1/4, sometimes 1/3 of everything there was to own in the country, which is not, you know, it's less than 50%, but it's not ridiculous. Whereas today, the government, of course, owns nothing at all, and in some cases, the public capital is negative. So look at Italy. You know, Italy is at the top of the class for private wealth and at the bottom of the class for public wealth. So public capital is negative in Italy, which means that they have more public debt than public assets. So even if the Italian government was to sell all the public buildings, all the schools, all the hospitals, you know, that would not be enough to repay their public debt. So, I'm not saying they should do that, and many people will be shocked if the government had to pay rent to the private owners of the schools to which we send our children. But in a way, this is already what we are doing, because when you have public debt that is bigger than the public asset, it means that you're paying an interest payment to the holders of public debt more than what you would pay in rent for the value of the public asset. So right now in Italy, interest payment is like 5-6% of GDP each year. And the total budget of the university system is like 1% of GDP. So is this the best way to prepare the future for the young generation in Italy and in Europe? I'm not so sure. And so, when you have such a low public wealth and certainly negative public wealth, maybe that's a bit too small. And this limits the ability of the government to invest in the public infrastructure and education and health, which is useful for development. And of course, it's not a coincidence if Italy is at the top of the list for private wealth. This is because the private households have bought the public debt directly or indirectly. So, of course, there are more extreme examples in the world of this process of transfer from public to private wealth. If I had the numbers for Russia, you will see the share of public capital has gone from 100 to 0 over this period, and the share of private wealth has gone from 0 to 100. And, of course, the Russian oligarchs, which you sometimes see in London, did not become rich by saving most of the time. They become rich. They become rich because there was a transfer of public, of assets from public to private and typically natural resources, usually at very low prices. And this contributed to the increase of private capital to income ratio. So sometimes this can be justified for efficiency purposes, to privatize the ownership, but you need some other forms of regulation. If you don't have public property, you need to regulate private properties through some financial regulation, taxation, and if you don't have any of the two, then maybe it can be a problem. So let me conclude by showing you some data about the evolution of top wealth groups as compared to average wealth. So I don't know how readable this table is, so let me read it. This is data coming from the Forbes ranking of billionaires in the world. So let me say very clearly that I don't consider this data as completely reliable, and I think in a way I would prefer to it's a bit sad to be in a world where we have to read magazines to learn about wealth. I mean, I have a lot of respect for magazines, but I think it would be better if we had Eurostat publication or IMF publications, but you will not find this information because official statistical institute use household survey with self-reported information to study wealth, which I think is a completely inadequate way to try to measure what's going on at the top of the distribution and what's going on in terms of cross-border financial assets. So, maybe one day there will be more financial transparency, automatic transmission of information that will allow for publicly published and reliable statistical data on wealth. But for the time being, we have to do with what we have. So in the book, I try to be pragmatic. I use fiscal data, I use national accounts, financial data. I also use magazine rankings just to see what we can learn from that. So according to this data, the average wealth at the top of the world distribution is rising at 6 to 7% per year in real terms between 1987, which is when Forbes started publishing their world ranking of billionaires, in 2013. So 6 to 7% per year in real terms. This is 3 to 4 times faster than average wealth in the world, which has been rising at 2.1%. So, of course, this cannot continue forever. By definition, if this was to continue forever, the share of world wealth going to billionaire will converge toward 100%, which I think everybody would agree is maybe a bit too much. So this will have to stop somewhere. And I'm not saying this will go to 100%. I'm sure inequality will stop somewhere. Now, where will it stop? Nobody really knows. In fact, maybe this data is overestimating the true rate at which the top wealth groups are going up. Maybe it's underestimating. We don't really know. It will be surprising if we had the perfect data that it will be reduced by 3 or 4 and bring it down to the average. But, nobody knows. Let me also make clear that, of course, you have a lot of mobility in this ranking. So the people at the top of the list in 1987 are not the same in 2013. So in 1987, according to Forbes, the top billionaires in the world are people from Japan, which everybody has forgotten their name, and in 2013 you have people from Mexico, from China, from the US, and that's fine, you have a lot of mobility. But now the fact that there is mobility and new entrepreneurial wealth in itself does not explain this fact that the average wealth at the top is rising 3-4 times faster than average wealth in the world. Because in principle, you have some people, if you were in an equilibrium of the world distribution of wealth, you have some people going down, some people going up. At the top, you have mobility, but these two effects should more or less compensate each other. Okay, and the average wealth at the top should more or less grow at the same speed at the size of the world economy. You cannot have the top rising 3-4 times faster than the size of the economy forever. There is something. So what's the explanation? I think the privatization of wealth over this period played a role. So you have a lot of big top wealth holdings which were made out of privatization, not only in Russia, but this happened also in France and maybe also in Britain and in Mexico and in different parts of the world. This played a big role. Another explanation which may have contributed is that financial deregulation may have increased the inequality in financial return. So when I talk about R bigger than G in the book, I think it's important to have in mind that the R is not the same for everybody. So the rate of return you can get on your investment can be sometimes much larger when you have a large investment than when you have a very small portfolio. And just to conclude with this and show you some illustration of this, these are the returns to the capital endowment of US universities over this period. So the reason I'm showing this to you is not to depress people at London Business School who have much lower endowments, although I learned that this recently increased up to 50 or even 100 million pounds, but still you will be in the bottom category of this group. So anyway, the only reason I'm showing this to you is that because we have good data on US universities' capital endowment. So at least these people publish financial statements. So I know what they do with their portfolio, and I can compute the returns they get, and I know what they do. Whereas the Forbes people, nobody really knows what they do. So at least here we have the data. And so we have 850 universities with capital endowment in the US, so we can look at this data set. And between 1980 and 2010, the average real return on this endowment, after deduction of inflation, after deduction of all management fees, was 8.2%, which is quite good. So clearly, they are not putting their money in US Treasury bonds, and some people do that in the world. I don't know why, but US universities have not done that for a very long time, and they've put their money in financial derivatives, in commodity derivatives, in private equity, and they've done pretty well. So I'm not saying in the next 3 decades it's going to be as high as this. I think probably this period was particularly good, but even if it goes down a little bit, this is still pretty large. And you can see also that the higher your initial endowment, the higher the return. It's pretty clear. You go from 6%, for the lowest endowment to 10% for Harvard, Yale, Princeton. So right now, Harvard has about 35 to 40 billion dollars in endowment. So they spend only 0.3% in management fees. But 0.3% of 40 billion is already 100 million. And so if that's enough to so you can pay a good team of wealth managers each year by spending 100 million each year, even if these people are costly to pay, that's still a good team. And if that's enough to get you a return of 10 rather than 8 or 10 rather than 6, it's worth paying 0.3%. Now, as long as it's only for university, maybe it's not so bad because they're doing lots of useful things with the money. But if you have, although this can contribute to inequality between universities in the US, public, private, and between private. But if this happens at the level of the individual distribution of wealth, you can see that this can contribute a lot to rising inequality of wealth. Just to conclude, and I know we are going to talk about philanthropy, private philanthropy. It's useful to compare these returns to the amount of private philanthropy giving to these universities over this time period. And we have the data because this is published. So for Harvard, on average, over this same time period, all the private giving to Harvard were less than 0.5% of the endowment each year. So as compared to the financial return of 10% per year, this is completely negligible. Okay? If you want in financial terms, if you want to understand why the endowment of Harvard has gone from 3-4 billion in 1990 to 30-40 today, you can forget about the philanthropy. What matters is the financial return. So, 0.5% is still something, and sometimes this can help to get your children admitted into Harvard. So that's certainly very useful. But in financial terms, this is very small as compared to this financial return. And I think it's important to have these numbers in mind because some of the discussion we have about private philanthropy sometimes these days, I think, are incredibly naive. We have these views that we don't need taxation anymore. We just need to wait for billionaires, to give money to education and health, and taxation is backward. And I think it's look. I like private philanthropy a lot. I have contributed to create the Paris School of Economics, which is a private foundation which attracts private money, and it's public-private financing, and that's very good. But I think this should come on the top of taxation, not instead of taxation. I think it's difficult to organize a society where you let people decide how much they want to contribute to the public good. So I think, it's important to look at these numbers carefully. And more generally, I think, taking a more, having more transparency on income and wealth and this historical evolution, which is what I try to do in this book, I think can, contribute to a more informed economic debate. So let me stop there, and thanks a lot for your attention.
Gavin, let's go straight on to you. Do you want the clicker?
Yeah. Morning, everybody. In China, I think 2014 is the year of the horse. Everywhere else, it's been the year of Piketty, hasn't it? He's been unbelievable what he's achieved this year, and he's sort of in my subject, and I don't know anyone else ever that has had the impact he's had with one book. Can anyone think of an example? So he's a pretty unusual kind of fella. The book that he's written is what in England we would call a tour de force. I'm not sure what you would call that in France. It covers everything from Balzac to Balassa Samuelson, and from austerity to Austen, Jane Austen. And he's brought together data, which really didn't exist before in any coherent manner, theory, and public policy advice in the most coherent manner. So, Thomas, I don't know how you did it, but it's absolutely fantastic. Thomas and I have one thing in common. We were both educated by Tony Atkinson, one of the greatest people in the subject. And Tony fought in barren, unfertile territory in the 80s and 90s to get the subject of inequality taken seriously, and here's one person who took it seriously. I didn't, though, unfortunately. I went off into the city and the financial markets and macroeconomics. So what I'd like to do in my time this morning is ask what Thomas' work has told me with my macroeconomic market hat on. Because actually, if you think about this, he's written about the accumulation of wealth, which is a subject that the financial markets are supposed to specialize in, asset allocation, fund management, etc. So if his conclusions are surprising to us, which they are in some ways, I think, then maybe it raises some questions about whether his conclusions are actually going to come true, or at least it raises questions for us about whether we should rethink the way that we look at the valuation of assets and the accumulation of wealth. Because the accumulation of wealth that Thomas shows in his book over the 21st century feels like a lot to a fund manager. And it comes, I think, to a couple of things which I just want to point out. And I don't know the way this will develop at all, but the continuous accumulation of wealth to income ratios at the pace that Thomas sketches out on in one of the chapters of his books seems like a bit of a stretch to someone like me who's trying to create that wealth in the financial markets. So three things I want to do. First of all, I want to look at what Thomas has said about how wealth accumulates briefly. Then secondly, look at what the economics profession has said back to him about the validity of his theoretical work in particular. And then thirdly, ask if there's another process that might be happening a bit distinct from his process that could also account for many of the numbers that he's shown here and in the book. And I think there is another process, a sort of amalgamation of some other macroeconomic forces that might be creating some of these changes in wealth and which don't have the same consequences for the future accumulation of wealth. So I'm not going to talk really about inequality. I'm going to talk about the accumulation of wealth. And on that, I'd like to start with just this page. Tom has already shown you the graph at the bottom, which shows wealth to income ratios rising in all countries since the 1970s. I think we all knew that had happened, but the way that he's documented this here is highly impressive. The other thing that's of interest, I've marked on the graph the countries, and there is something I think interesting and totally in line with what he says. The countries with the highest wealth to income ratio start with Italy, Japan and France, then they go down to Australia and the UK, and they finish with the US and Canada and Germany, which is an exception I can't personally explain. But the interesting thing about that sort of league table of wealth to income ratios is that the slow growing economies are at the top and that the fast growing economies, certainly demographically fast growing, are at the bottom. So he's dead right there. It seems to fit his theory rather nicely because his theory is in the little blue box with red writing. What Tom has done, I think, in the main, or two things he's done, but one of them is he's taken the Robert Solow growth model, 1956 version, and he's shown the steady state of that model. And in the steady state of that model, the wealth to income ratio, beta, is equal to or the savings ratio over the growth of the economy. And one of the consequences of that, which he points to, is that if you reduce G, the growth of the economy, you would expect in steady state to have a higher wealth to income ratio. Now, in part, I'm actually not sure if it's in part or in whole, that's due to reducing income. Because remember, we're looking at the wealth to income ratio here. But in any event, that is the steady state in the Solow model. And it seems to explain the rise in wealth, given that growth has slowed over this period of time. And it also seems to explain the league table of countries. So he's got a lot going for him here. And the other thing that I think is really interesting, many things obviously, but one thing I'd like to point to in Thomas' work is that he really has opened my eyes to the possibility that these rises in wealth to income ratios are not abnormal, but are a return to normal. And that is an enormously mind-opening thing for me. Because living through my lifetime, my adult life from 1970 to now, I've just watched wealth to income ratios after 1980 rising and thinking, God, this has to stop. There's something wrong here. How can this be the case? Because for me, normal was what I saw in the 50s and 60s. Thomas says, actually, that was very abnormal. Take a longer look at this over centuries. And actually what you find is the last couple of decades are in part to be seen as a return to normal. You can see that on the top graph there, which just shows UK wealth to income taken from him. Financial assets are about half of the total and housing the other half. Land is not worth anything now really in the economy. But the U shape that Thomas mentioned is very clear in that graph. Bottom graph shows Europe and the US over a long period of time, U shape again. Now, asset managers have tended to think over the last couple of decades that the increase in the wealth to income ratio is kind of abnormal and is taking assets into overvalued territory. And I think, at least for me, one of the things that I've had to reassess since reading the book is maybe I'm wrong about that. Maybe my whole life has been in abnormal territory and we're now seeing a return to normal. And what he says is, not only that, it's going to go on for, you know, a lot longer. I'm going to take these wealth to income ratios a lot higher. The right-hand graph here just shows my recent, I've just taken this off a database this week, showing what has happened in the last 5 years in the US and in most other countries. We've seen a big surge in the wealth to income ratio. I think that reminds us that these things are extremely volatile. So even if you think he's right over a 20, 30-year period, you can get a lot of bear markets in the meantime, and that's worth remembering. So what has the economics profession said about Thomas' use of Solow and this equation that says beta equals S over G? Well, one member of the profession says he's right, and that's Robert Solow himself. But what does he know? So, you know, I'm going to beg to differ with him. Really the only serious, I think, throwback that the economics macro profession has produced after the book has been published has asked Thomas to rethink the rate of depreciation in this equation, I guess, is what people are asking. This comes from Per Krusell of Stockholm and Tony Smith at Yale mainly, but others, including James Hamilton, have said the same thing. And basically what they say is that there's an ambiguity in some of Thomas' writing about whether he's taking net or gross saving at the top of this equation. And what they say they now teach, and what is standard practice in all macroeconomic models that I'm aware of taught in lecture rooms today, is that the rate of depreciation has to be taken into account. So savings, in order to add to capital, have to be higher than depreciation. And that changes the equation. And it changes the equation in a very simple way from S over G to S over G plus D, with depreciation in the denominator, right? Now so what? Okay, the so what of this is that once you put a depreciation rate in the denominator, you get somewhat different dynamics to a lower when you reduce the growth rate. What Thomas said is, you reduce the growth rate and actually you substantially increase S over G and therefore the wealth ratio, right? If you've got a depreciation rate of 5% at the bottom of that equation, this is all explained in this thing which will be on the web later, then you certainly don't have an explosive increase in the wealth to income ratio, which Thomas doesn't really expect, but you have a much smaller increase. And whether it increases at all, you know, depends on another thing, which is what effect does lower growth have on savings? Because I think implicitly Thomas mostly assumes that he can reduce the growth rate G without taking much account of depreciation, and that, but when he reduces the growth rate, it won't reduce the savings rate. Now again, most macroeconomists would say in a lower growth environment, you probably will be reducing the S. So the two sort of theoretical reasons that I think that have been raised that worry me anyway, I don't know if they worry you, Tom, but they worry me, is number one, should we be adding a depreciation rate at the bottom of this steady state solution? And number two, should we allow for the fact that when we reduce G in the denominator, we should also reduce S in the numerator? And I think that has some effect on the conclusions and worries me a bit about the medium-term conclusions that Thomas has come up with. And I'd encourage more debate on this, and the only person that can have this debate is sitting here. Last thing, is there another explanation for all of this that isn't quite the same as what Thomas has written? Now, remember, what he's done is by taking steady states out of growth models broadly, is he's looking at one equilibrium here in 1970, one equilibrium here in 2010, and he's not looking at how the two are connected in terms of the dynamics of the macro process in between. So it's comparisons of steady states, okay? That's what he's done. In sort of macroeconomics, where we're worrying about cycles and policy, there's sort of developed an alternative explanation for this, and I'd just like to end with this because it's somewhat different. And Charles Goodhart has recently written about this, and others have too. The BIS has written a lot about it. And I guess the alternative explanation, which is more of what I would call a macroeconomic cyclical type, disequilibrium explanation, if you like, is that the real killer fact that has set all this off is a reduction in the labour share of income, which started in about 1980, has happened in every country, and has continued pretty much year by year since then. Now, of course, Tom would say, well, I told you, that's part of my process. I told you that. But I think the key thing about these alternative explanations is that they start from that. It's not part of the process. It's really the trigger for the process. And it's driven by either globalization or by technology, technical change, or by a loss of union power, or in some cases by the reduction in the price of investment goods, which can have this effect. So the cause is the loss of labour power to maintain its share of national income. What that then does is it reduces inflation, it leads to easier monetary policy, but it also has exactly the effects that he talks about on inequality. And as inequality rises, aggregate demand fails to keep up with supply, essentially. And you start moving into a secular stagnation trap. And you have to ease monetary policy more and more to get to deal with that. That pushes asset prices up more and more. And as you get sort of stuck in that trap, you might be pushing asset prices above equilibrium. That's really what I think the BIS thinks is happening. And if that is happening, then the future from these asset markets, at least for a decade or two, may not be quite as he sketched out. It may be much harder to generate the kind of returns on assets from what many market people see as overvalued assets to get the kind of increases in wealth and deterioration in wealth distribution that Thomas talks about. Last point, and then I'll sit down. The one thing that I don't find much of in the book is really any great discussion about the risk-free real rate. Is there much in there, Thomas? There's a bit in there.
Probably it's too short, my book.
I don't know, because I've read the book 11 times, so
Yeah, okay.
I don't know. Anyway, to me, it didn't appear like there was a heck of a lot. But is it not true that the increase in wealth that we've seen over the last 3 decades has to have as a central part of the explanation the drop in the risk-free real rate? I mean, look at that on the graph here, which is it on the left? We all know this, but that's just the nominal and real rate on US Treasuries, collapsing through time. The real rate now down in negative territory. I think that has to be a central part of the generation of wealth, genesis of wealth in the last 3 decades. And if that's not a central part of the explanation, then I think it's a bit missing. It is a central part of the secular stagnation explanation, but not so much, I think, anyway, of Thomas. So I'd like to ask him what he thinks of that. Thank you.
Great. Well, thank you, Gavin. I'm very struck by your comments about this is a return to normal. I think that's sort of what I believe has been going on. But I'm also thinking about, on your last point about the labour share of income, if you think about the other book that has done very, very well this year, it's The Second Machine Age by McAfee and Brynjolfsson, which essentially argues that globalization and technology change, we ain't seen nothing yet, and that the potential job destruction of middle-class jobs over the next 10 years, 20 years is going to be sort of orders of magnitude bigger than what we've seen before. Now, I'm not completely convinced by that. I sort of, as an economist, I always feel lump of labour fallacy sort of jumps into my head, and maybe new jobs will come as technology comes along, as has always been the case in the past. But if we buy that scenario, you know, the inequality, you know, and then Uber. I mean, I'm fascinated by Ubernomics, really. How does Uber change things? If you go back to Ford in the early days of Henry Ford, he was very much paying people more because he wanted to create middle-class demand for his cars. Now we're in the world where Uber's going to come along and potentially, you know, take traditional taxi drivers out of the business, then create lots of low-paid people doing taxi driving as portfolio jobs. But then we're going to have the driverless car along in a few years' time. And so there'll be no one doing any driving before. And actually, who's going to? So we're going to have fewer cars maybe in the world, and so less demand. And it's very interesting how that may all play out. Anyway, one of the advantages of going from academia to journalism is that you can occasionally, when you writing a story, go and stick a camera in front of someone's face who's a participant in the story and ask what they think. And I just wanted to play a brief clip of an interview I did earlier this year with Bill Gates, where I asked him about inequality and got his view on the subject. Now, you're off to the World Economic Forum in Davos, where one of the topics on the agenda is the rise in inequality around the world. Do you worry about that at all, or are you primarily happy as long as poverty itself is being reduced at the bottom?
Well, I think the human values are that children should survive, kids should have enough nutrition, people should be educated. You know, we'd like average lifespans to be in the 80 plus years for every country. If you're achieving those goals, and at the same time a few people are getting ridiculous amounts of money, I'd rather have that than sort of the communistic ideal of equality. So equality isn't the sole goal, because 500 years ago we had equality. We were basically all poor and dying at a very young age. The number that I think is worth tracking is consumption, because wealth numbers, if I'm a medical graduate in the US, my wealth number looks like negative $100,000. Am I really worth negative $100,000? That's when they do these, comparison. That person shows up as poorer than the poor, and yet, they're going to go on to earn this big.
But
income.
I mean, this week's big number is like a third of the wealth of the world is owned by 85 people or something like that. I mean, does that number mean anything? Do you think?
My wealth is, you could say it belongs to me, but actually, it's temporary. It's going back to help the poorest, and so. It's inventing vaccines for them, helping to deliver vaccine for them. And so, do you really count it? When people hear the statistic that Oxfam gave out, they often think, oh, that means the poor are getting poorer. No, the poor are not getting poorer. We have a lot of work to do. There's 1 billion in extreme poverty, another 1 billion in relative poverty. But if you think things are getting worse, then you'll miss the fact that we have examples of things that have worked phenomenally. Okay. Vaccines have worked phenomenally.
Great. Well, I mean, that gives you a sense of a different perspective maybe on what's going on. And it's interesting that he brings up this issue of consumption, because Thomas has done this wonderful work on data on income and wealth, but try and get any information on consumption by rich people. I'm trying to do this at the moment, and there's absolutely nothing out there, so it's impossible to know whether Gates is right that consumption inequality is not as dramatic as some of the other aspects of inequality. I want to talk very briefly about a theme that I picked up on in the book I wrote called Philanthropy Capitalism that I wrote with Michael Green, where we really looked at this rise in inequality and as a return to normal, and saw and asked the question, what's the social contract that will be needed to underpin a more unequal society. And we basically looked at, that's Andrew Carnegie's Gospel of Wealth, which is very much an essay that is the sort of must-read book or essay for the American philanthropist of this generation, but also now, if you look at people like Jack Ma in China, who's setting up a foundation, been influenced by Carnegie's work. And Carnegie, as you probably all know, I mean, he basically said that the administration of wealth was the biggest challenge of his age, which was the late 19th century, that essentially anyone who died rich died disgraced by the fact that they were rich, because the job of the wealthy person was to give back their money during their lifetime in order to basically prevent the rise of socialism, communism, and so forth, the other threats to a capitalistic society. And so, I mean, and I guess you could argue that to some extent that worked in America not perfectly, but certainly they didn't go down quite the revolutionary path that others went down, and arguably that's why they came through the 20th century, or part of the story as to why they've come through in better shape, although hardly a perfect society. I wanted to pick up particularly what I set up as the sort of Gates versus Carlos Slim model, which I know you very specifically look at in your book and dismiss in about a page, which is about the shortest dismissal of your entire book. But it's interesting to me because, in a way, you take issue with the previous sort of economic blockbuster, which was Acemoglu's book, which makes your book look short, to be fair. But there they very much look at why countries fail, and they look at very different capitalistic systems. And it seems to me, the Mexican system of Carlos Slim, is the kind of inequality model that doesn't really augur well to survive over the next few years. I mean, there's going to be a lot more social unrest. We're seeing it building up in Mexico. Very closed system, very little commitment to philanthropy, very little commitment to allowing dynamism and entrepreneurial spirit, capture of the state by very wealthy business families and so forth. It does seem to me that Gates is fundamentally different, and the American model is fundamentally different because it is a dynamic entrepreneurial model. Gates may have been guilty of antitrust violations, but only after having made a contribution that is extraordinarily positive to the well-being of the world and the wealth of the world, and maybe many of his defences in the antitrust suit look a lot better today than they did at the time in terms of there being a creative destruction process. Mark Andreessen, who ran Netscape, is now the hottest thing in venture capital, so he's not done so badly out of being the victim of antitrust. So what we saw, or the victim of sort of monopoly. I mean, what we saw in that. What we're seeing now, I think, is a debate that is a response. Now in your work, Thomas, you talk about a wealth tax as being the best solution to this. I don't really see that as a viable strategy, and instead it seems to me that we need a debate about how do we create a social contract that works between the rich and the rest of us. And it is encouraging to me that we're seeing a shift in the business world from the sort of Milton Friedman-esque view that the duty of business fundamentally is to maximize profits subject to the law, to something which is much more about what does it mean to be a good business person, an ethical business person. Clearly that is a debate in its infancy, and the change is more rhetorical than real in many companies. But we have things like, we have examples that are really quite interesting to look at, like Unilever. The trouble is it's hard to find other examples beyond Unilever, but nonetheless they are there. They are trying to actually double the well-being of their customers and halve their environmental footprint and so forth. We also see the giving pledge. Now, one of the interesting things was that Gates, when I spoke to him when my book came out in 2008, he said, well, one of the things you get wrong in the book, not much is wrong, he said, but you get wrong the idea that there's a movement of philanthropists. Now, 2 years later, he and Warren Buffett launched this giving pledge, which is an attempt, I think, to persuade the wealthiest people in the world to actually publicly commit to doing philanthropy. And they now have over 120 signatories, which is clearly still a fraction of the total number of billionaires who have publicly pledged to give away at least half their wealth in their lifetime. Now, is that in itself going to be transformational? Is that going to provide enough basis to sort of keep down the broader demand for action against rising inequality? I mean, I think a lot of that is going to depend on whether they really can do philanthropy that is meaningful in addressing the underlying problems. And I think, in a way, the interesting thing about Carnegie and others in America was I think they did actually underpin a lot of the institution building in the early 20th century in America, a lot of the interesting thinking about poverty and education and equality, racial equality, and a number of other areas where they really did some quite radical things. Today, I mean, the question is, will the amounts of philanthropy given away, which are still tiny, as Thomas points out, relative to the capital markets, will they actually achieve leverage in terms of social change? That is going to involve a lot of things. I call it the art of the possible, but it's basically today you have to work with social entrepreneurs, businesses, governments if you want to achieve social change. In Carnegie's day, it was maybe you could do a lot more on your own. But essentially, are they going to play well with others? Are they going to figure out how to partner in the political realm in a way that's really meaningful in the way that Gates has been doing with vaccines and some of the other work on global health? And is that relatively small amount of capital in the pot relative to the large amount in the capital markets, are they going to be more like venture capital? So is it going to be the 30 billion given away each year by the billionaires, or by the super rich in America? Is that going to be more like the 20 billion invested in venture capital in Silicon Valley, or is that going to be more like twice the New York schools budget, which basically achieves not a lot in a couple of years and goes away quite quickly? Are they really going to achieve outsized impact? And will the public actually say that's enough, or will they actually want more and more to crush inequality as a goal in itself, regardless of how the wealthy behave? Anyway, so in the book, our last chapter, we talk about the need for a new social contract, and we argue that there are 4 components to what we call the Good Billionaire Guide, all of which, as you can see, are hugely contentious subjects that we can each have a long debate in every society about what exactly they mean, but it seems to me they have these 4 components, one of which is to make your money ethically. There, I think Gates broadly is on the side of, he has done. Slim, I think, I wouldn't want to say publicly what I think there, and certainly some of the Russian oligarchs are probably even less ethically based in how they made their money. Paying reasonable taxes, well, what is a reasonable tax? I think we certainly agree that what people are paying at the moment, if you're wealthy, is not reasonable, and certainly Warren Buffett's comments about paying a lower tax rate than his secretary, seem to be a reasonable starting point for what is not reasonable. And it'll be interesting to see if the OECD efforts to really crack down on international tax competition, actually open up the possibility of some movement in the wealth tax direction. Thirdly, I do think the Gates point that wealth is a stewardship responsibility, and that you are going to give most of it away, that idea is catching on, not least because I think they now have such absurd fortunes that they know they can't spend it on themselves, and they know that they worry a lot about the effect that their inherited wealth will have on children. The British aristocracy have done the world a favour with their awful experience of hereditary wealth. That's a great exemplary case. And then finally, to actually give effectively, which I think is the biggest challenge of all, how do you actually put this money to work in a way that really, demonstrably improves the world? And I think that's where, if Gates succeeds in what he's trying to do, which is very metrics-based and very much focused on proving that his money is making a difference, that, I think, could have a very powerful effect. And there are a number of other initiatives that I'm looking at by a number of other super philanthropists who are trying to achieve very dramatic change and trying to embed this in data. Now, if we started to have in 5 or 10 years' time a record that being wealthy and being a committed good billionaire actually did improve the state of the world, then I think some of these concerns about rising inequality would go away, particularly if we were seeing, as we have been seeing, the poorest getting better off around the world. But as I said at the start, if you buy the view that technology is about to wipe out most of the jobs, then that challenge is going to be even more urgent, and we need much more engagement around the topic of how on earth we're going to find purposeful ways to live life at a high quality level if you haven't got the ability to earn a living doing it. So those are a few reactions, and I guess first of all, Thomas, just over to you to respond to Gavin and myself, and then we'll throw it open to everybody else. Thank you.
Oh, thank you. So let me maybe respond in the reverse order and start with Bill Gates and philanthropy, and then move back to the alternative explanation for the rise in capital income ratio and the debate also about the second machine age. And I very much agree with a lot of what you've said. So regarding philanthropy and Bill Gates, so I had this very interesting discussion with Bill Gates recently, where he wanted to have a Skype conversation with me before he was writing a review of my book on his blog. And basically what he told me is, okay, I like your book a lot. I agree with everything that's in it, but I don't want to pay more tax. And this is, and basically I understand his point, but so he seems to believe that the amount of tax that he's paying in the US right now is reasonable. You seem to disagree, or at least Warren Buffett seems to disagree. so his point is, okay, I don't consume a lot, so the tax should be based on my consumption. So he told me, okay, I'm ready to pay a very progressive tax on consumption, 80%, 90% for very high living standards, very high consumption level, which is what Calder, a British economist, had in mind in the 1950s, where he proposed a very progressive tax on very large level of consumption. But at the time of Calder, the proposal of Calder was on the top of the income tax and the inheritance tax that existed at the time. It was not a substitute. So Bill Gates is really pushing the idea of consumption tax further because he seems to say, okay, I just want a tax on when I consume a lot, but otherwise I don't want to pay a tax. The problem is that the very notion of consumption is not so well defined when you are very wealthy, because you cannot, when you have billions of wealth, your personal consumption in the sense of food or clothes or car, this cannot be a very high fraction of your economic return to your wealth. This will always be a very small fraction. So what you can do when you're wealthy is you consume influence, you consume power, you consume academics, you consume politicians, you consume journalists. But there are very different ways to consume. And when you the notion of personal consumption, is not so well defined. So. And, I can see rankings of wealth everywhere in magazines. I don't see rankings of consumption because, it would be very difficult to enforce a progressive tax on consumption. Then you would have to define. So, when Bill Gates is taking his corporate jet to go somewhere, is he consuming? Is he investing? It's not so clear. So, how do you treat all the intermediate consumption within corporations? I think this will be a totalitarian nightmare to enforce a progressive tax on consumption. And so, in fact, I think when people are proposing this, what they have in mind is a flat tax on consumption, basically. And in the end, you end up with a good VAT or, some other form of flat consumption tax, and you have no progressivity at all. So I think, most of the time, it's a very hypocrite way to push away the very idea of progressive taxation. So, I can see where this can be in the interest of Bill Gates. I'm not sure this is so much in the common interest. And so, when you give, I'm sure Bill Gates is doing more useful things with his money than Carlos Slim or a number of Russian oligarchs. But it's difficult in the tax code. You're not going to put a moral value to every wealthy person. So. In the case of Bill Gates, when you give money to a foundation of which you are the president, of which your wife is the co-president, and of which the board members are members of your family, and so on, is it a disinterested gift, or should we define disinterested gift as giving money to an institution of which you are not, the director, and you're not yourself consuming the power and the influence which comes with it? I think. It's difficult to let people, private individuals, define for themselves what the common good is. And, I think, I can see Bill Gates believes that he's more efficient than the government. That's fine. But, it's difficult to organize society with thousands of people who individually believe to be more efficient than the government. You need to have some common ground of taxation and as you said, it would be useful to start with a situation where Warren Buffett and Bill Gates pay at least as much as their secretary, but I think it would be reasonable to put a slightly higher standards. And when you discuss with Bill Gates, what's interesting with the comparison with Carlos Slim that you made is that he had this discussion with Darren Acemoglu when Darren published his book, where he said, okay, I like a lot your book, but I don't like the bad things you say about my friend Carlos Slim, because, he's also, he's doing good things with his money as well. And, and I had the same discussion with him, and I asked him, okay, if you have a consumption tax, how do you define the consumption of the Koch brothers in the US? When they give money to political action committees, is it their personal consumption or is it private philanthropy? And he started to defend the Koch brothers, basically. So, it's a bit unclear. At the end of the day, he doesn't seem to make the difference between himself and Carlos Slim and the Koch brothers, and you seem to be making. And I think, this is, he's defending, in a way, the interest of a group to which he belongs, which, is, I can understand, but, is it in the common interest? I think it will be a bit naive, And I think, again, the idea of a progressive consumption tax, I think, is just a way to avoid paying tax, to put it bluntly. And so I'm not so convinced by the argument. But at the same time, I believe in private philanthropy. And, again, I contributed to the creation of a private foundation, the Paris School of Economics, and, I have money from private donors, and that's perfectly fine. But I think it must come with reasonable taxation, and these days, we tend to move in a direction where sometimes the middle class is paying much higher effective tax rate than people above them. Small and medium-sized companies are paying higher effective tax rates than a number of large multinationals. And, I think in the long run, this is a serious threat to the social contract. I'm not sure people will accept paying tax, if they feel that some people above them are paying much less than they do. So this is a serious problem. Do the efforts by OECD or others, is this going to solve the problem? I think we are still far from the solution. I think we need to use multilateral agreements to do that. I think it would be a mistake to have big multilateral agreements, for instance, between the European Union and the US on trade liberalization without putting any fiscal dimension to this kind of agreement. It's not often that you put half of the world GDP around the table to have a binding multilateral agreement. And so if we don't take this kind of opportunity to take decision on financial transparency and minimal tax for large multinational corporations and automatic exchange of information and cross-border financial assets, it's going to be hard to explain to the public opinion, what we are doing. And I think we need to show that globalization, which, of course, I am in favor of trade liberalization, but we need to show that globalization can come together with global fiscal justice. And otherwise, if we lose that kind of opportunity, I think we take the risk that more and more people will feel that this is not working for them and that globalization is not working for them. So now let me move to the other issue, which is the other, explanation for the rise in wealth income ratio and capital income ratio. And let me say that I very much agree with pretty much everything you said. I think the slowdown of growth and the working of the simple solo model where, for a given rate of saving and investment, when you have lower growth, you tend to accumulate a higher wealth of income ratio is only part of the story. And, I think, if it was the only story, then the book will be very short. And part of the reason why the book is long is because there is a lot more than this going on. In particular, the changes in the relative price of assets and the increase in particular, the price of real estate in the long run, it's as I said in my presentation, that's a big part of the increase in the wealth income ratio. Now, are these just overvalued assets, and are they going to fall, in the next 5 or 10 years? It's not so sure because, as I said, I think it's also part of, when you have to put your money somewhere. So if you have a low population growth, a low growth of the underlying economy, and you don't want to put all your money in China or in other parts of the world, you have to put it somewhere. So there could be something structural in this high real estate price. You can also find some long-run explanation in the structure of technical change, to explain a structural rise in the price of certain assets. If you have slower productivity growth in the construction technology and in the transportation technology, like, the planes today are not very different from the plane 40 years ago in terms of speed and etc., as compared to progress in information technology or biotech. So if you have a different speed of technical progress in different sectors, this can certainly increase in the long run the relative price of certain assets, typically real estate in large capital cities as compared to other goods and assets. So you can, this structural change in the price of assets can contribute. Another sort of real explanation is the sort of second machine age argument. So that's really a very, very interesting book. And basically the idea is, the rise of robots and more capital-intensive technology can explain the rise of the capital output ratio and at the same time the share of national income going to owners of capital. And if this is true, of course, then you have to care a lot about who owns the robots, basically. So the distribution of the stock of capital becomes an even more important issue. Now, I don't think, so far, maybe this will be important, in 2020, 2030. Now, as you said, or 2050. Now, as you said, there can be other forces going on. For now on, I don't think this is really what has been going on. I mean, for now on, the real capital-intensive sector in the economy, which explains the rise in the capital income ratio and the capital share in recent decades, are much more traditional capital-intensive sector like real estate or the energy sector, and it's much more important than robots. So maybe in 2030 or 40 it will be different, but for the time being, in order to understand this process of rising capital income ratio and rising capital share, I think the right model is a combination of the solo model, but also with a multi-sector model where you have a real estate sector, an energy sector, and the relative price of the assets in these sectors are changing. The bargaining power between labor and capital is playing a role. I also agree, the monetary policy factor can explain part of it. In some cases, the increase in real estate prices is clearly excessive. Some of the reason why the level of the capital income ratio in Germany is smaller than in Britain or France is because the real estate prices have increased a lot less in Germany. But the trend is the same. So you still have the same increase in the capital to income ratio. So the level is different because of this relative price effect, but the general evolution is the same. And if you make the average for the whole of Europe, you take the whole of Europe together and you compare Europe, Japan, the US, in the end, they are quite close. I have a graph where they show they are quite close to the 45-degree line in the sense that the pure solo model effect explains relatively well why you have higher capital income ratio in Japan, middle in Europe, lower in the US. So just the effect of saving and growth, because lower growth does not necessarily reduce saving. In the case of Japan, for aging or for various reasons, you can keep saving. The rate of return, of course, as you increase the capital to income ratio, I show in my book that the rate of return, whether you take the risk-free rate of return, which is not so easy to define in general, or you take the average rate of return to capital, this is declining. But this is not declining as fast as the increase in the capital income ratio, so which is another way to say that the capital share is increasing. Now, in the long run, again, there's a mixture of forces that will determine this, including technological forces. Let me conclude by saying very clearly that I am much better at analyzing the past than the future, and that I'm trying to understand past trends, but I very much agree with you that there are very different forces going on. Just one little, very technical point. Capital depreciation is, of course, included in every of the series. Otherwise, we could not explain the evolution, because depreciation is typically half of investment. Gross investment is can be sometimes 20-25% of GDP, and net investment it can be 10%. So if we were not taking that into account, that will not work. I did not fully understand, to be honest, the point of Krussel and Smith about depreciation. I think I certainly agree with them that one reason, depreciation is one of the reasons why the capital output ratio will not go to infinity, because then, depreciation will be so huge that it will take all the GDP. But, I have never said that it will go to infinity. That would be a very strange prediction. I just said it will go high, but, it will certainly stabilize somewhere. I'm just saying that it will stabilize to a ratio of, 6 or 7 or 5 or 8, but bigger than the ratio of 2 or 3 that we had in the 50s and 60s. But, I certainly agree that depreciation is one of the reasons why it's not going to go to infinity. But there are other reasons as well, which is just that if your capital output ratio was to go to infinity, if we have pile of capital going to the sky, the return, of course, will go to zero and nobody will be saving anymore. So even without depreciation, it's clear that this will stabilize somewhere. So all I am saying is that it will stabilize at a higher level than what we've seen in the past.
Great. Well, let me quickly take some questions.
James McIntosh, FT. Just wondered about China and the potential impact. You focus really on intra-country distributions of wealth. There's obviously been a massive equalizing effect across country, that we've got a billion Chinese who are now far better off than they used to be. But first of all, that aspect of things, and then second of all, how much that's an explanatory factor for what's going on, particularly in the US, that you've added 1 billion new Chinese workers, which obviously depresses labor. At the same time, you've had China invest trillions or lend trillions to the West, which pushes up asset prices, and how much that could be an explanatory factor, given that started in 1980, which is exactly when your charts take off.
Great. Thank you. There's a lady in the middle there.
Henrietta Royal, British Bankers Association. One of the things that I've not heard any particular address is, of course, the difference between what we had prior to the Second World War is really an absence of the sort of pension arrangements that we have now. There's a lot of focus on what the top 10% of people have, but of course, the rise of wealth across very large numbers of people in terms of pensions is a completely transformative characteristic of the second half of the 20th century and the beginning of this century. I'm wondering how that affects your thoughts on this.
So let me start with pension wealth and the rise of the welfare state. No, that's a very important evolution which has contributed to reduce social inequality in general a lot. So in my book, this comes in part 4 of the book. So I start by looking at the market sort of pre-tax distribution of income and wealth in the first 3 parts of the book, and then in part 4 of the book I introduce taxation and the welfare state and the public pension system, and of course that's very important. This has been a very powerful force to reduce inequality in the long run. That's very clear. Now, in terms of the wealth to income ratio, whether you include public pension wealth in private wealth or not, that's not going to change the evolution of the national wealth, because if you put public pension into private wealth, you have to put it as a liability on the public wealth side. So the wealth accumulation, the wealth accumulation itself will not be affected. But it has a very big. Oh, so that's included, of course. Private funded pensions are, of course, in private wealth, but pay-as-you-go pension are not. And pay-as-you-go pension intervene, in a redistribution of income and plays a very important role in redistribution of income. But the fact that you have more, but that's not affecting the overall evolution of the wealth to income ratio. But that's very important for redistribution. So I think it's a different evolution from the wealth to income ratio that I am describing. But that's very important. Now regarding China. I think globalization and as you say, the fact that you have 1 billion workers from China that arrive into the world labor market, certainly this is an important factor behind the rising inequality within rich countries. Now,
and would you accept Gates's point that the poor are getting better off generally in the world?
Oh yeah, many of the poor are getting better. Yeah. But I think we could do even better. But yeah. It's yes, that's for sure. Yeah, I start the book. Chapter 1, chapter 2 in the book are really about the international distribution of GDP, and I start by looking at the convergence that is going on in the world between emerging countries and rich countries, and that's largely due to globalization, and that's very positive. And I have no problem with this. I fully agree with this. Now, what's interesting though is that although you have a reduction of inequality, between the bottom and the middle in the world, the top is rising a lot faster than the average, including at the world level. So it's not only within the US or within Britain. When the data I showed you on top wealth groups, this is global data, this is world data, and still, the top is rising 3-4 times faster than the average, in spite of the fact that you have China in the average. So you could think that the inter-country reduction of inequality will be enough to reduce inequality between the top and the middle. And I think in China this is becoming a serious issue as well. So I was very fortunate in China to have also a debate on CCTV with Jack Ma, and then just like Bill Gates, he believes that private philanthropy will be enough. I think the Chinese are seriously thinking of developing a system of property taxation and inheritance taxation, which they don't have at all right now. And I think the way they try to fight inequality and corruption is very much in the Russian way, in a sort of case-by-case basis, and putting in jail a few people from time to time. And I'm not sure this is so efficient. And I think developing a tax system with transparency, I think is important. And maybe the main thing I have learned in this debate about the book, and I don't know if it's the strongest critique, or at least to me, what I'm trying to now to push further into is to study more emerging countries and inequality in emerging countries, which are not sufficiently included in the book. It's not entirely my fault. It's that sometimes the access to fiscal data was not possible. And one good thing with the publication of the book is that, as I said earlier, we can now access data in Brazil, Mexico, Korea, Taiwan that we could not access before. Now in China, this is still a country where you have an income tax, but you have no income tax statistic at all. You don't know at all how the number of taxpayers by income brackets is changing year after year. And I think if they were to publish this at the local level, this could be a way to fight corruption and to see in some cases that the tax system is not really being applied so well. So, I think it's important not just for academics to have statistics, but also for the regulation of society itself. And, in Mexico, the issue of corruption, there's very little transparency about fiscal data, income and wealth. And I think this can help move in the right direction. So,
well, I think without doubt, Thomas, I mean, your work has provided such compelling evidence that no one can pretend the problem or the facts aren't there, and I think this debate about what we do about it and what the social contract is going to be is just going to get bigger and bigger over the next few years. So thank you very much for leading our conversation.